The legal economic illusion of money, an examination of currency, value, and fiction. This lecture explores the abstract nature of money, clarifying that its value is derived not from substance or intrinsic worth, but from sovereign authority, enforceable taxation, and collective legal recognition. 1. Currency has no intrinsic value. Modern currency, whether in the form of paper notes or coins, does not possess intrinsic or commodity value. Contrary to popular belief, a banknote is not money in and of itself, it is a record of government-issued debt. Coins, although historically made from precious metals, now merely imitate that aesthetic while offering no material worth. There is no legal or physical link between contemporary currency and gold reserves. Footnote: this section asserts that money no longer derives its value from precious metals, but from sovereign debt recognition. 2. The gold standard is absent from all modern currencies. No major or minor world currency today is backed by gold or any other tangible asset. Attempts to redeem a note for gold, whether in the United States, the United Kingdom, or the European Union, will yield only another note of equal denomination. The gold standard has been entirely decoupled from contemporary fiat systems. Footnote: this section emphasizes that the historical practice of redeeming currency for gold is obsolete in all current monetary systems. 3. Legal tender derives value from tax authority. The sole factor preserving the value of national currencies is the state's legal right to tax its citizens and mandate payment in its own currency. This tax obligation underpins demand for legal tender, effectively anchoring abstract currency to real economic consequences. Money retains value because governments demand it back. Footnote: this section identifies taxation as the mechanism that grants fiat currency its enforceable value. 4. Numbers on screens replace physical currency. The perception of value in digital banking is a result of collective legal conventions. Reductions in one account and corresponding increases in another are interpreted as payment. Nothing physical moves, rather, society consents to recognize these adjustments as economic activity. The illusion is legally binding through digital equivalence. Footnote: this section explains that digital transfers, not physical exchange, constitute the functional basis of modern payments. 5. The process of payment is merely record-keeping. At its core, payment is a numerical adjustment. A transaction between two accounts facilitated by digital bookkeeping. No cash is moved, no coin exchanged. Payment occurs when numbers are debited and credited via institutional software. This is the fundamental architecture of financial settlement. Footnote: this section defines modern monetary transactions as a function of digital record modification. 6. Money is created through lending. Money enters circulation when banks issue loans by inputting values into a digital ledger. There is no vault, no movement of funds, only keystrokes. Each loan creates an equivalent deposit. Thus, all money is simultaneously a liability and an asset. This is the dual entry mechanism of money creation. Footnote: this section demonstrates how the practice of double entry accounting underpins monetary creation. 7. The keyboard is the printing press of the digital age. A modern bank's most powerful tool is not a vault but a keyboard. Inputting loan values creates new money, while further key entries reassign it. These activities are not metaphorical, they are literal executions of monetary expansion, regulated by accounting protocols, not physical constraints. Footnote: this section characterizes the act of typing loan entries as the literal act of modern money creation. 8. Money is a legal and psychological construct. Money is not a substance, it is a consensus. Its existence is contingent upon shared belief, codified law, and institutional trust. If that consensus were to collapse, so too would the value of money. Therefore, money exists as a legal fiction, sustained by software, laws, and the belief in future tax enforcement. Footnote: this section concludes that money is best understood as a collectively upheld legal fiction.